Hello, everyone, and welcome back to a new accounting episode. Uh, Welcome back, and I would like to introduce what we're going to have today. Today, we're going to talk about the balance sheet. We have talked before about the double entry and how any financial transaction uh, is has always affects two sides of an accounting or two different accounting. And today we're going to talk about one of those financial reports, which is the balance sheet. So in the balance sheet here, we got uh, many vocabs here. I'm not going to go through them as I'm going to define each one of them as we're going down the video or down the session, and I will try to define one by one. So let's talk about the financial claim. What is a financial claim? A claim is what liabilities, let's say in this case, here's a business that got some assets, and here are some liabilities, which is what a business owe to the creditors, and they have a claim toward these assets, as well as the owner's equity, which is how much owner or owners will claim from the assets. So it's property, creditors, financial claim, owners, or owners, financial claim, both are okay because an owner might have a partners, or stockholders. Those are called owners. So the next one here, it's a good example. Let's say in an asset, a business assets, let's say there's cash of $100 cash in the box or in the cash or in the business account. $100 out of the $100, $40 are owed to the creditors. So the creditors or this business borrowed $40 from some people or some businesses or some creditors, which is $40. So basically, the claim of the owner towards these assets is only 60. You have $100 in your pocket, though you have borrowed $40 from a friend. So actually, you only have 60 is what you really have in your pocket. Though you have 100, but out of those 140 were borrowed from someone else. So only $60 is what really you should have in your pocket. Uh, Just a simple example to this case. Now let's say here a famous one, the accounting equation. What is the accounting equation? The two sides of the accounting or the two sides of balance sheet is assets equals liabilities plus owner's equity. Assets equals liabilities plus owner or owner's equity. Now, let's take the famous one here, the balance sheet that we're going to focus on today. So, same equation as we have seen before. Assets is to the left side, which is the debit side. On the credit side, always to the right side of the balance sheet, we have liabilities, debts, bottom line, and owner's claim, owner's real money that he can claim towards the assets. So assets equals debts and the owner's equity, or what owners really have out of the assets. Now, in assets, we got two column. We got two parts. We have current assets, fixed assets. In current assets, we're talking about less than 1 year. Things that properties that owned by a business and it's used or it's owned for less than 1 year. The most famous 1 year we got is cash, the bank account in cash. Same thing, deposit is going to be also on cash, or receiving money is also cash. So let's say here and cash. So cash, if I would say a business pays one of his creditors or purchase goods, let's say a business purchase goods on cash. So what happens? Cash is going to be reduced. So I can say when a business buys a goods on cash, then his assets will decrease. or assets, where his asset will decreases, if I could say. So, and meanwhile, if I would say that, I may not say this, and I could say assets will increase as well because we're talking about stock, inventory, merchandise, goods, stock, all are the same thing. When a business purchases goods here, so I could say assets increases as well. So whether I would say cash goes down, stock goes up. So if cash goes down, assets in this case decreases. Goods goes up, then I could say assets increases. The next one I have here, supply. Supply is not got nothing to do with goods. Supply could be stationaries, detergent, soap, napkins, Kleenex, cleaning stuff, whatever it is, things that used for maintenance or to keep the place clean and so on, or used for office work. So supplies is also one of the current assets. And in supplies, if I would say, let's say a business buys supplies on account. So what happens here? Supplies increase, so I can say business buys supply on account, supply increase, assets increases, and account payable increases as well if he's going to buy on account. On account, on credit are the same thing. On account, on credit goes here. So when it goes here, that means liability increases, his debts increases. So supplies increases and liabilities increases as well because he bought goods or bought supplies but did not pay. He is going to pay later. So it's going to be documented or recorded or posted or recorded, if I could say, or listed under accounts payable. Now, accounts receivable. When this accounts receivable occur, it happens when business buys goods on account, or he's gonna promise to pay later. It's the same thing. As long as he did not pay cash, so that is gonna be here. It's gonna be sales goods on account sales. When you sell goods on account, that means account receivable will increase, assets increases. Meanwhile, when he sells goods here, that means goods went out of his business, so also assets will decreases as well. So assets may decreases because goods are sold. Assets may increase, I'm sorry, because he paid it on accounts. He's going to record no cash. He's going to put it here under account receivable. Repaid expenses. That means prepaid expenses means you pay someone in advance. That's also count on assets. So prepaid expenses. When you pay some expenses in advance, you pay the rent in advance. Rent is going to be done or listed under expenses. Rent, utilities are not liabilities. Rent and utilities, salaries, and all these stuff, they are fixed costs. So they are not liabilities. They are not liabilities. Those are operational, the operational costs. They're fixed costs. They don't happen. They don't occur when because of the business transaction. It happens because it's going to happen. It's a fixed asset. You're going to have to pay your rent no matter what happens. You sell, you don't sell, you make profit, you make loss. You're going to have to pay your rent, you have to pay your utilities, you have to pay your salaries. Okay, so next one I have here, furniture. When someone buys, a business buys furniture, what happens? So let's say business buys furniture, two cases. There are no third one. It's whether you're going to pay cash or you're going to pay later on or on account. So that's going to be account payable. So when business buys new furniture, the furniture does not last for a year. You're not going to buy an office just to use it for 1 year, or a desk, I'm sorry, or any kind of furniture, table, not for 1 year. So furniture bought and paid cash. So what happens here? Assets increases, that's for the furniture. Assets also decreases because you paid cash. So assets increases or assets decreases because furniture has gone up and cash has gone down. So this is the other, that's the first case. Second case, buying furniture and you promise to pay later. So you're buying furniture on account. So assets increases, liability increases. The debt is going to increase because you did not pay cash. So it's whether you buy cash or you pay later on, which is on account. Same thing here. Buying cars, same way. Cash, I don't think people buy cars on cash. You always take a loan or something. However, buying a truck, car, vehicle, vans to a business, assets increases because of cars. You have two cars, you get the third one, so assets increases. Account payable, I don't think it's going to be for 1 year, so maybe it's going to be here. However, it's a liability, and liability increases as well because you bought it on account or on a loan, whatever. So trucks, cars, vehicle, vans, all are the same thing, all under fixed assets. Why? You're not going to buy a car for 1 year. You're going to buy a car for more than 1 year. Okay, now let's go back to equipment, land, building, all are the same. You take a loan, most likely take a loan to buy a building, land, or equipment, a machine. You're not going to buy a machine for millions of dollars on cash. If you have this money, God bless you. Okay, equipment, land, building. So when it happens that you buy one of those or get a new anything of those, that would mean assets increases and liabilities increases. Again, it's based on that I don't think you're going to pay it in cash. If you want to pay it in cash, good luck, great. Then assets may decreases as well because you paid in cash. However, most cases, equipment, land, and buildings, they are all bought on loan. So assets increases and liabilities increases as well. Why? Because it's a debt. So let's move to here. I think I have covered all of these ones. Account payable, loans are liability. 1 year, it's less than 1 year, it's current. More than 1 year, 2, 3, 4, 5 is fixed. However, both are liabilities. Buying goods or things on loan, that means you're not, it's going to be a liability increases. Now let's talk to the last part, which is the owner's equity. Owner's equity is a claim of the business owner or business owners to the assets. Remember, the $100 less 40 equals plus 60. 100 equals 40 plus 60. Same example we had here before. 100 equals 40 plus 60. 100 equals 40 plus 60. Now, owner's equity is basically the money that business is interested to have in business. So it could be his cash when you start a business. So let's say that someone starts a business, he put like $100,000 on the bank to start his business. So in this case, cash increases, so assets increases, equity increases as well. So this guy with no debts, he put 100 on his account. He owns this, he owned this 100. So 100 equals 100, no liability in this case. But if he puts $100, he borrowed 40, so he has only 60. However, let's not get to this case. A business owner deposits money in his account, whether it's starting off the business or during a business or whatever it is. Equity increases, cash increases. This could be equity decreases? Yes, there's a case that owner's equity decreases. When a business owner withdraw cash from his business for his own use. So in this case, cash decreases, assets decreases. Owner's equity decreases as well, because he borrowed money. He took money from you. So that will go down, and his claim to this is going to go down as well. Imagine if the $100 only, no, that's $100 to $100. When he withdraw $20, that means his cash will be $80 only, cash decreases. And his claim to this is not 100 now, there's only 80. So his claim is 80. 80 to equals 80. However, a business deposits cash, owner's equity decreases, cash increases. I'm sorry, owner's equity increases, cash increases. That when he deposit cash. When he withdraw cash, owner's equity decreases, cash decreases. So assets decreases as well. Common stock, when a business puts some stock on the stock market to increase his capital. He wants to borrow money from public, not from the bank, from public. So he sells them stock. Stock goes to the stock market and it's fluctuated, it goes up and down. That's a different story. However, if he puts some stock on the stock market, that means owner's equity increases and also cash will increase because he's going to sell them on cash. Okay, retained earning. Be careful with this word. Retained earning could mean profit, could mean loss. So what happens when a business at end of the year has made some profit? Would that reflect? Owner's equity increases because he made profit. If he made a loss, owner's equity decreases. So profit goes under owner's equity. Loss goes also under owner. That's at the end of the year. I think I have covered most of those. I don't think there's any other listed item here that might have missed some, but most likely this is the majority or the majority of those items that I would like you to know for today. Well, I would like to thank you again for joining me, and I wish you all the best, and I will see you again shortly. Thanks for listening to me, and I will see you shortly. Thanks again. Have a nice day.